Rupesh, shall we start the session?
Sure, sir. Able to hear properly? You're able to hear properly, sir?
Yes, yes, I'm able to hear you. Yeah.
Okay, sir. So, dear all, welcome to the webinar. Myself, Planner Advisory, working with Dilsa, having 10 plus years of experience and did my NISM 10A and 10B. And we also have Mr. Sridhar from the research, and he So he also having the certifications of NASM 10A and 10B and having a mechanical engineering background with an MBA and working with himself from the past 2 years. And today, our beloved speaker is Mr. Amarnath. I will share his profile also. So Amarnath is a CA in practice. He has over 20 years of experience in the fields of expatriate taxation and tax consulting. He started his career in the International Executive Service Division of KPMG Global Services, where he worked on US tax return and related complaints for expatriates. Later, he worked in the international tax practice of Deloitte, Bangalore. His expertise includes various facets of global mobility like expatriate tax, social security, localization agreements, ESOP taxation, etc. He was part of SME team in Deloitte, which deals with PF and global social security matters. He is an active member of the team, which makes industry representation to MEA through NASCOM in the matter concerning social security legislations. In his current role, he provides various complaints and advisory services relating to the individual taxation, both from India and US taxation perspective. He also handles representation before the tax authorities in case of tax audit and appeals. Now it's all over to Mr. Amarnath, sir. You can start.
Okay. Thanks, Rupesh, for the introduction. So, good evening, everyone. As Rupesh has given a good introduction about me, so I need not talk about my introduction again. So, I would like to thank everyone who has made some time to attend this seminar on that too on a Friday evening. In this seminar, we are going. I just shared my screen. Is my screen visible, Rupesh?
Yes, sir. It is visible.
Okay. Yeah. Okay. So today's topic is share stock awards, nothing but stock options. So there are different kinds of stock awards. Let us deep dive into the meanings and the events and the taxation, cross-border issues, reporting, everything. So basically, I'm going to cover the types of awards in this session. There are different kinds of awards, like the popularly you might have heard about ESOP. But apart from ESOP, there are several other kinds of stock awards as well. Let us see what are these awards, and then taxation of these awards. How would the tax work, especially in India? Is there any difference between the taxation rules with respect to the type of award, or everything is the same? So, what is the cross-border taxation mechanism, especially considering US? All that we will look into. Then tax planning avenues available with respect to stock option income or the gains which you have made from sale of these options. Then, as I already mentioned, the cross-border taxation with respect to US as a country, how US sees these stock options, and what would be the taxation in case of mobile employees, basically people who are touching different countries during their entire stock life cycle, stock option life cycle. How would the taxation impact those people? Then double taxation mitigation, if any, with respect to these stock options, and then the other issues, basically FEMA issues. Any restrictions applicable as per FEMA with respect to these stock options. So moving on to the types of the these stock awards. These are the different types of stock awards which are generally prevailing in the market. So the first is the ESOP, which is nothing but the employee stock option plan. So as the name itself indicates, this is an option given to the employee. This is not a mandatory benefit. Just because it is granted, there is no hard and fast rule that the employee has to accept the same. Only when it is vested and exercised, it becomes the employee will become the owner of the stocks. And also, it is purely an option given to the employee. Generally, these will entail a price to be paid by the employee to acquire the stock, which is generally the fair market value as on the date of grant. So, when you look at the date of grant and the date of exercise, if there is any appreciation has happened between this date of grant and the date of exercise, that is going to be the benefit for the employee. Generally, at the time of grant, the stock price may be very less, or if it is already trading in the market, it may carry a good amount of fee, which needs to be paid by the employee to acquire the ESOP. Okay. Then it comes to RSU. RSU is a restricted stock unit. So this is also a type of stock award given by the employer. As the name itself indicates, it comes with certain restrictions. There will not be any price to be paid by the employee in case of RSU. So this is being issued at a zero price. So it does not carry any price. So as on the date of vesting or exercise, what we call it as, whatever the value of the RSU or the stock, that entire thing is going to be a benefit for the employee. So what are these restrictions? Restrictions could be with respect to the service period or performance criteria. When it comes to performance, it could be of an employee performance or company's performance or a combination of these two. So there could be a lot of factors considered in case of RSUs to be issued by the employer. Then comes a peculiar thing called ESPP. ESPP is nothing but an employee stock purchase plan. Under this option or under this type of award, what happens is the employee has to pay a regular sum of money, more like an SIP, for a period of 3 months or 4 months or 6 months, depending on the policy of the company. So at the end of the 6 months, whatever the price of the stock and what the employee has paid to acquire the stock in the form of monthly payments, the difference between these two is considered as a benefit. So here the benefit is nothing but a discount what the company is offering in the case of the stock. So say for example, in company policy says that the employee has to contribute every month 1,000 rupees to acquire the stock of the company. So for a 6 months period, if the employee has paid 6,000 rupees, and if the value of the stock is 6,600 rupees as on the day at the end of 6 months, he will still get the stock at the rate of 6,000, and that 600 rupees is the benefit what he is getting, which is a discount of around 10%. So that is the ESPP. Then comes the SAR, which is stock appreciation rights. Stock appreciation rights is also a very peculiar stock award, and this is very rarely seen in the market, especially where there are no further stocks to issue to the employees, or promoters may not want to dilute their stake in the companies. So in these cases, the companies will come out with the stock appreciation rights. How this works is, this is basically a notional award where certain stocks is being deemed to be given to the employee. From the date of grant to the date of exercise or vesting, whatever the appreciation in the price of the stock is paid as a cash component to the employee. So, in strictly speaking, this is the employee is not going to get any stock out of it. He is going to be benefited only with respect to the appreciation which has happened in that stock award. So, say for example, today the stock price is 100, and the company policy says that after 3 years, if you are still in the company, then I'm going to pay you the difference between the fair market value of the stock after 3 years and today, whatever the difference, I'm going to pay that as a cash component. So after 3 years, if the price has gone up to 500, the employer will pay 400 rupees as a cash bonus to the employee. It is taxable as nothing but a bonus incentive kind of a thing. This is called a stock appreciation right, but that incentive is completely linked to the appreciation of the stock. If the stock has goes up only to the extent of 200, then the benefit is only 100 rupees to that employee. So these are all the different types of stock awards which are generally prevailing in the market. And as you all know, this is a retention strategies which is being implemented by the companies to retain the employees. At least once it is granted or vested, the employee may not going to leave depending on the benefits of the award or the stock option which has been given to him. So this is acting as a very good retention tool, and it has been there in the market for several years now. So in that way, it is a very good, very popular incentive scheme as well as a retention strategy for both employee and employer respectively. So then moving on to the next slide, the events during the entire stock award cycle or a stock option cycle is basically starts with the grant. At the time of grant, grant does not give any right to the employee to become an owner of the stock. It is just an option given by the employer to exercise the stock, and that option has been accepted by the employee. It materializes only at the time of vesting or exercise depending on the type of the stock. So grant is nothing but a right is given by the granted by the employer, and that has been accepted by the employee, which is going to vest at the future date. So at the time of grant, there are no tax implications, and only the price in the case of ESOPs, as I already mentioned, the price as on the date of grant is considered as the price to be paid by the employee, which is going to be the cost for the employee. So then comes the vest. Vest is the period where it gives an unconditional right to the employee to acquire the stock. So in many cases, vesting is considered as in many countries for that matter. Taking US as an example, vesting is considered as a date of accrual of the benefit to the employee since he is going to get the legal right to exercise the stock award. So in that way, vesting is a very important criteria. And in case of RSUs, vesting is the date where it is going to be considered even for the purpose of taxation. So then comes the exercise. Exercise is nothing but exercising the right given to him. In some cases, especially in the case of stock options, post vesting also, there will be some period within 2 years or 3 years, the employee has to exercise the stock award. So if he is not going to exercise, then the stock will expire. So he will not have a legal right to get that stock later on. So in that perspective, exercise is a very important event, and this is applicable only in the case of stock options and not in the case of RSUs. In the case of RSUs, vesting and exercise will coincide in the same on the same date. The both will happen one after the other. So it is more or less automatic. So once the RSU gets vested, it is deemed to be exercised as well. Then comes the sale. So on the date of vesting or exercise, depending on the stock option type, the employee will become the owner of the stock. It gets credited to his demat account. So post that, he is the owner of the stock, and whenever he wants, he will get right to sell or retain or whatever he wants. He can do post that exercise thing. So the last event is the sale. When the employee sells it, then it legally he will be disposing the stock award, and the life cycle of the stock award ends there. So these are the four different events which are very crucial in the case of stock awards. So moving on to the next slide, it's a very interesting slide of today, the taxation of stock awards. So as I said, from India tax perspective, what is important is the allotment of the stock. The law and the rules talk about allotment as the stock event. But when you look at the stock events, allotment is nowhere here. So what does this typically mean? So this typically means that in the case of RSUs, the allotment happens post vesting. So in case of RSUs, the taxing event from Indian tax perspective is the vesting. And in the case of ESOPs, the employee will become the owner of the share only at the time of exercise. So in the case of ESOPs, exercise becomes the allotment date, and then that becomes the taxable event as well. So what happens? What is the benefit to be considered as a taxable benefit. So as I already explained, what is the benefit in the case of ESOP? It is the difference between the fair market value at the time of grant and then the price paid by the employee. Sorry, fair market value at the time of exercise is the basis to determine the taxation. So minus the price paid by the employee, which is the fair market value at the time of grant generally. So the difference between these two is the taxable benefit for an employee. But in the case of RSUs, there is no price paid by the employee. So it is basically zero. So fair market value as on the date of vesting minus zero is the taxable benefit in the case of RSUs. So in the case of ESPP, we already discussed the discount is the benefit given to the employee, and that's going to be the taxable benefit as well. In the case of SARs, in our example, we already saw the difference between the value on the date of grant and vest is considered as a perquisite. So the appreciation of the stock between the grant and the vest is going to be the taxable benefit in the case of stock appreciation, right? Similarly, there is another event of taxation, which is the sale. See, allotment, it becomes a salary income and the benefit is considered as a perquisite. And the taxes also will be withheld by the employer at the time of allotment. The benefit will be reported in Form 12BA in the Indian context, and which basically forms part of Form 16 as well. And also taxes would be deducted. Then comes the sale. Another important event in the case of stock awards is the sale. So once you become the owner of the stock, you can sell at any point in time. So what is the taxable benefit at that time? You have already paid the tax on the fair market value of the stock at the time of exercise or vesting. So that becomes the basis or the purchase price for you for the purpose of calculating taxable benefit at the time of sale. So sale price minus fair market value at the time of exercise or vesting, depending on the stock award, is going to be the benefit, which is nothing but a sale price minus the value considered in your Form 16 as a benefit is what you are going to be taxed as a capital gain. Basically, the excess of the amount what you have made as compared to your Form 16 thing is what is going to be taxed. In that way, the double taxation is also avoided. I mean, it is not taxed on the entire sale proceeds, but only on the excess of gain made above the fair market value as on the date of vesting or exercise is only taxable as a gain. So just to summarize this taxation, what happens allotment at the time of allotment, head of income is salary income, and what is the tax rate applicable? It is the slab rates which is going to be applied because it is going to be part of your salary income. Then reporting will be on Form 12BA, which necessarily gets into your Form 16. Form 12BA is a part of your Form 16, and if there is any stock option given by your employer, you have to collect Form 12BA as well and give it to your tax advisor for preparing the tax return. That's a very important document from a tax return filing perspective. Just see this from through an example. So see, ABC Limited awarded 100 ESOPs to Manan on 1st January 2023. These were vested on 31st December 2023 and exercised by Manan on 31st August 2024. These were granted at a price of rupees 10. Fair market value as on the date of exercise is rupees 1000. So these are stock options, I mean ESOPs, and so it has come with a price to the employee, which is 10 rupees he has paid. And the fair market value as on the date of exercise is 1000 rupees, that is as on 31st August 2024. So this 1000 minus 10 rupees is becomes 990, and 990 is the taxable benefit which is going to be taxed by the employer. You might be thinking that there were significant amendments in the budget, and so what are those? Is it going to impact your salary taxation or a perquisite taxation on the stock awards? All those amendments are with respect to capital gains treatment only. There is no amendment or the change with respect to calculation of the gain or the taxability of the perquisite, I mean the benefit for salary purposes. So there are no changes, and whatever was there earlier, the same thing is going to continue for the purpose of calculation of taxable benefit by your employer. and also taxes would be withheld on this 990 rupees at the slab rate. It is going to be added to your salary income. Yeah, this 990 is nothing but 99,900 rupees based on the, I mean, for 100,000, 99,000. Yeah. Then comes the sale. At the time of sale, what is the head of income? It is going to be taxable. It is taxed on the head capital gains and not as a salary income. Tax rates, there are significant amendments which we are going to see in the below table. Then the reporting, there is no reporting for the employer to report anywhere. It is your obligation to report this sale in your respective income tax return. So coming to tax rates, depends on whether it is a long term or short term. So if the stock options are listed in India, only in India if it is listed, then if you are holding the stock option for stock, not option, stock for equal to or less than 12 months, it is a short term gain. So what is the holding period here? From when you need to calculate it? It is not from the date of grant, it is from the date of exercise in the case of ESOPs, or it is from the date of vesting in the case of RSUs. And from that date where you became a owner of the stock, from that date, if you are holding the stock for less than 12 months or equal to 12 months, then it is short term gain. It results in a short term gain or loss. And if the stocks are listed in India and if you are holding it for more than 12 months from the date of exercise or vesting, as the case may be, then it qualifies as a long term. So, what is the tax rates applicable? So, if you are selling the stock which is listed in India before 23rd July 2024, then for short term, the tax rate is 15%. And if it is sold after 23rd July 2024, then it is 20%. And if the stock is a long-term stock where you are holding more than 12 months, then and if it is sold prior to 23rd July, it is 10%. And if it is sold after 23rd July, then it is 12 point, on or after 23rd July, it is 12.5%. Now comes the unlisted stocks. Unlisted stocks includes the stocks which are not listed in anywhere in India. It might have been listed abroad, but that is still considered as unlisted for India tax purposes. So all the stocks what we see, whether it's Google, Amazon, Microsoft, Shell, or Unilever, all these are unlisted stocks for India tax purposes, and accordingly the capital gains have to be computed. So in the case of unlisted stocks, what is short term? If you are holding that for less than or equal to 24 months, then it is short term. And if you are holding it for more than 24 months, it is long term. Again, in the case of stock awards, the period has to be considered from the date of grant, not from the date of grant, from the date of exercise or vesting, as the case may be. So if it is a short term, and if you have sold these stocks prior to 23rd July, then slab rates are applicable for computing the tax purposes. And if you have sold it after 23rd, on or after 23rd July, also it is slab rates because it is a short term. And if it is a long term unlisted stocks, and if it is sold prior to 23rd July, 20% is the taxation with indexation benefit. And if it is sold on or after 23rd July, it is 12.5% without indexation benefit. Tax rates is substantially reduced at the on the same way, even the indexation benefit is taken out. So that's the reason why the tax rates have been reduced. So in the case of unlisted stock option, no more indexation benefit if the stock is sold after 23rd July, and the tax rate applicable is 12.5%. And as I mentioned, foreign stocks listed abroad are considered as unlisted for India tax purposes. Let us see an example for the sale. So MS Inc. granted 3,000 RSUs to Pranav on 1st Jan 2019 with a vesting period of 3 years. FMV, these are all RSUs, it's not ESOPs, and RSUs are granted on 1st Jan 2019 and the vesting period is 3 years. Fair market value as on the date of vesting, that is as on 31st December 2021, is rupees 1,000 per share. Pranav sold all these shares on 1st May 2024 at rupees 2,000 rupees per share. So he got these stocks in on 31st December 2021, and he sold these stocks on 1st May 2024. And because these are RSUs, entire 1,000 rupees is going to be could would have already been taxed as a salary income. So for 3,000 multiplied by 1,000, basically it is 30 lakh rupees is what he has paid as a salary income. Taxes have already been suffered. So that 30 lakhs becomes the purchase price for Pranav. And as on 1st May 2024, whether he has held it for more than 24 months or less than 24 months, yeah, obviously it is more than 24 months he has held these stocks, and he has sold prior to 23rd July. So this 30 lakhs is taxable at the rate of 20% with indexation benefit. He sold at 2,000 per share. So the entire sale proceeds is 60 lakhs, and 60 lakhs minus indexed cost of acquisition, which is 30 lakhs after indexation. It may come to around 35 or 36 lakhs. So the difference between 60 lakhs and 35 lakhs, which is 25 lakhs, is going to be the taxable gain in this case, which is taxed at the rate of 20% plus surcharge and 4% cess, if applicable. Then sometimes we see even these sale to cover transactions. So when you look into the Google share sold document, it could be from a E-Trade or Morgan Stanley or Schwab. They will say taxes are covered sale or sale to cover taxes. So what exactly this means? Many, even the professionals, they get confused that this has been taxed at the time of sale. So it is a capital gain tax, whether it is paid for India or whether it has been withheld, or is this a taxable transaction for the foreign country and the stocks have been sold to cover the foreign taxes. No, this is basically salary, I mean taxes on the taxable benefit for salary purposes, which has been considered as a perquisite, and to cover those taxes. See, employer has a withholding obligation on that perquisite, and if the employer is going to deduct this huge amount in that per 1 month's salary itself may not be, that entire month's salary may not be sufficient for him to withhold the taxes, and that may result in a huge cash flow issue to the employee as well. So in order to avoid those practical challenges, companies will generally put in their policy itself as for the purpose of tax purposes, that is for withholding tax purposes or TDS purposes, company will have a right to sell the stocks which are equivalent to the tax amount. So sale to cover is nothing but the protection given to the employee and also to the employer, and also a right to the employer to sell the stocks to the extent of to cover the tax amount. So the same example continuing, the perquisite value is 30 lakhs. And how would the taxes be covered from employee for TDS purposes? So on 30 lakhs, assuming roughly the tax on this would come to around 10 lakhs, to the extent of 10 lakh shares, which is 1,000 RSUs, will be sold by the employer. He will have an exclusive right to sell those stocks, and he will recover the taxes through that. So to the employee, basically only 2,000 shares will be credited to his demat account, though 3,000 RSUs are vested. Now the question is whether this transaction need to be reported in ITR as a capital gain. And many times when I discuss with my clients also, they say that there's no gain or loss, it is sold on the same day. So see, the gain or loss may be very minuscule. Sometimes it will be in some few hundreds, or sometimes it is few thousands also, depending on the number of stocks and the pricing and the timing of sale and all these things. Come what may, whether it is 100 rupees or 1,000 rupees or 10,000, please report this in the income tax return. Tax authorities are getting this information through exchange of information from the overseas country, the sale to cover transactions, and they are issuing notices saying that you have not reported any capital gain in your tax return, but there is an information with us that you have sold some stocks during the year. So it is advisable that you promptly report even sale to cover transactions. The documents will definitely be available in your stock portal, which could be E-Trade or Schwab. So download that information and provide to your CA so that he will consider this at the time of filing the tax return. So just to summarize the stock option taxation, there is no impact at the time of grant and also vesting in the case of ESOPs, because there is no benefit accrued to the employee. on the time of exercise in the case of ESOPs, or at the time of vesting in case of RSUs and stock appreciation rights. Taxable benefit would be fair market value as on the rate of exercise minus the exercise price paid by the employee is considered as a perquisite value, and this benefit which is considered as perquisite value becomes the purchase price on the sale time. So the capital gain would be sale consideration minus fair market value on the date of exercise is what is, or simply to put that, it is a perquisite value which has been considered for at the time of vesting is what becomes the purchase price. So shares allotted by foreign company to employees in India is liable to tax in India, and these are considered as unlisted shares. And in the case of vesting and exercise dates coincide, the benefit will be taxed at the time of vesting, typically in the case of RSUs. So fair market value means it is the value determined by the merchant banker, and your employer would already consider that from the merchant banker you would have obtained, and then accordingly you would have considered. So, in case of non-resident and resident but not ordinarily resident, we will see that as an example in the further slides. The pro rata income alone would be taxable in India. So certain tax planning aspects. What are the tax planning aspects? I mean, not much, I would say. There is only one tax planning under Section 54F of the Income Tax Act. And let us understand this through an example. So MS, it's the same example I have taken here. And the value is 2000 per share, assuming he got all the 3000 stocks to his demat account. So 1000 rupees per share. So we will presume for the time being that 30 lakhs is his gain on this transaction. So what is exempt here? It is the gain which is going to be exempt, which is 30 lakhs. So what are the conditions? The investment has to be in a residential house property and within India. So amount to be invested, entire sale proceeds have to be invested. This should not get confused. It is not only the gain to be invested, it is the entire sale proceeds need to be invested in the new residential property to avail the exemption. And there is a timeline prescribed also. The property should have bought 1 year before the date of sale of these stocks, or 2 years after in case of ready to move in property, or 3 years after, I mean within 3 years if it is a constructed property. So if you are constructing the property within 3 years, you should buy these shares, buy this house property. Or if you are buying the ready to move in property, which is 2 years, and it could be even 1 year prior to the date of sale. All these years have to be reckoned from the date of sale of the stock. It is not from the end of the year from that in which you have sold the stock. It is from the date of stock. It is 3 years. So some other conditions to be mentioned is, I mean, if you are unable to invest or buy the property within this 2 years or 3 years timelines, before filing the tax return, you should have invested this property in the capital gains account scheme. Capital gains account scheme is a separate account which you need to open with any banks which provide this service, and you have to deposit this amount with that account, and only for the purpose of buying a property or constructing a property the amount will be released by the bankers. And another important condition which you need to keep in mind is, as in the date of sale of stock, you cannot have more than one house property, which means to say that you can be the owner of one property already, and also you can buy one more property. So if you are the owner of the property for more than two houses as on the date of sale of stock, then you are not eligible. See, sometimes what happens is people will say after selling the stock, they come to me and they say that, okay, now I will dispose this property. This is a old property. I mean, it won't give me that much of money. That's not going to work out. As on the date of sale, if you are the owner of more than one property, then you are not eligible to avail this exemption. So, I mean, before selling the stock, if you really want to avail this exemption and invest the proceeds into a residential house property, please consult your CAs before doing the transaction, before selling the stock award, so that you can plan the events well, and also you can avail the exemption without any hassles. So now we will see the cross-border taxation in the case of stock awards. So this is in the case of a mobile employee. Sometimes what happens is employees during the life cycle of the stock award, which could be from grant to vest or grant to exercise, employee may be touching two different countries. Taking the same example, MS Inc. Granted 3,000 RSUs to Pranav and 1,000 rupees per share. Perquisite value is 30 lakhs. And Pranav is a US resident from 1st Jan 2019 to 30th June 2020 and is a resident of India from 30th June 2020 to 31st December 2021. So how is this going to be taxed? Is this entire 30 lakhs is going to be taxed in both the countries, or at the time of vesting I am only in India, I am not part of the US entity at all, so I do not have any connections with the US entity. Can I say that this entire 30 lakhs is going to be taxed only in India and I'm going to pay taxes to Indian government? No, in the case of stock options, it is very peculiar. In these cases, what happens is the respective portion of the stock income, which is pertaining to the services rendered in each country, has to be prorated and then offered to tax in the respective countries. So in this case, I have to make the calculation easy. It is basically 50-50. Like he has stayed in uh, US for 18 months and in US for 18 months and in India for 18 months. So 50% of this thing, like 15 lakhs, will need to be reported in the US tax return. Basically, your employer will withhold the tax on that 15 lakhs US taxes, and he is going to issue W2. Nevertheless, it doesn't matter whether you are on the rolls of the US entity or you have come back to India and there are no connection with the US entity, still you are going to get W2 for this income. And similarly, India is going to consider that 15 lakhs and it is going to be taxed as a taxable benefit and included in your Form 16. So depending on this, the taxation differs in case of this is basically like non-resident and resident, but not ordinarily residents. But irrespective of your residential status, for ease of practical purposes and to mitigate the cash flow issues, employer would have taken a position that irrespective of your residential status, he is going to report pro rata income on the Form 16 and W2. In those cases, if you are a resident and ordinarily resident in India, it is your duty to report entire 30 lakhs on the India tax return and claim foreign tax credit for the 15 lakhs portion which you have offered to tax in the US. So in the case of mobile employee, this becomes a little complex calculation. So please consult your CA and provide all the documentation to enable him to make the calculation simpler and also for an accurate reporting in the tax return. Then comes the taxation in the US. How is it going to be taxed? We saw how this is going to be taxed in India. At the same time, let us see if your employer is or the company which is based out of US is giving you the stock option. Generally, what we see is most of the companies are based out of the US and they're going to get the stocks which are listed in the US. So let us see how this is going to work in the US. See, in the US, basically these stock awards will give you three types of income. One is salary income till the date of vesting or exercise. Then comes the dividends. Once you become the owner of the stock and if you are retaining the stock, if the company grants the dividend or issues the dividend, you are going to get dividend income on these stocks. And then comes the capital gains at the time of sale. So if you are a US resident, generally US residents, basically if you are living in India and becoming a US resident means typically you will be a green card holder or a US citizen. In those cases, the salary income is completely taxable in the US. Dividends are also taxable in the US. Capital gains are also taxable in the US. But generally, what we see is the non-residents of the US, basically resident Indians who does not have any connection to the US, or they might be in the US for some time and now they have repatriated back to India. How is this taxation is going to work? Salary income we already saw only for US days it is taxable, provided you had any US service period during the stock option life cycle. Then comes the dividend income. Dividend income is taxable at the rate of 25% as per the double taxation avoidance agreement between US and India. Then comes the capital gains. One very good thing or a very tax advantageous thing is US is not going to tax on the capital gains income if you are a non-resident of the US. That is why even in the case of sale, even though the sale happens in the US, the broker is not going to withhold any taxes on the sale amount or the gain amount. However, if it is a dividend, he will definitely withhold the taxes. If you have provided W8 Ben, then it is the tax rate applicable for withholding purposes is 25%. If you have not submitted W8 Ben, then it is taxable at the rate of 30%. So he will withhold 30%. So basically, those dividends are going to be taxed in India as well, provided you are a resident and ordinarily resident. And again, as I said, to mitigate the double taxation, if either the taxes are withheld or you have filed a return in the US and paid the taxes, you can claim the tax credit in India on the double taxed income, which is basically dividends. Capital gains, since there is no tax in the US, there is no question of double taxation arises. Only in India return you will report and pay taxes in India. So one typical question which comes is, as a US non-resident, I am getting these dividend income and capital gains. Do I have a filing requirement in the US? The answer is, if the taxes are adequately withheld on the dividend income, there is no need to file US tax return. So you can rather skip the US tax return filing. It's not mandatory. So even in the case of capital gains, since the gains are not going to be taxed in the US, there is no tax return filing requirement. But if you are a green card holder or a US citizen, yes, you must file the US tax return and report global income in the US return. So now comes the reporting in the India tax return. Very important thing is the schedule foreign assets. There is a separate schedule called Schedule FA. If these stocks are foreign company stocks and not listed in India, then Schedule FA is mandatory, and irrespective of your income level, or you may not have a return filing requirement, and if you are holding the foreign stock, then you must file the tax return and you will file a nil return by reporting these stocks. So in the case of foreign assets, it is mandatory for the assessee to file the tax return in India, even though he does not have any income. And as I already mentioned, there is no reporting threshold also in the case of foreign stocks. So details of foreign equity and debt interest need to be reported, which basically asks for the country name and address of the US entity. Entity here is not E-Trade or Charles Schwab. It is basically which company's stocks which you are holding. It could be Amazon, Google, or Microsoft. Those entity details need to be reported. The date of acquisition of the stock need to be reported. Initial value, which is the purchase value. Basically, the price which has been considered for perquisite valuation becomes the initial value. Then the peak value is nothing but if you have got the additional shares, or if you have bought the shares from the open market, then the value goes up. Then the closing balance, which is at the end of the year. Then gross income which you have received. If you have received any dividend income, the same needs to be reported in the schedule. Also, if you have sold any stocks, the proceeds need to be reported. And the reporting period is very, very important. It is not the financial year which goes from April to March. It is actually the calendar year. For all foreign asset reporting purposes, irrespective of the country where the asset is situated, you must follow the calendar year reporting, which is Jan to December, and report all these values and information based on the calendar year only. And if the income exceeds 50 lakh rupees, this needs to be reported in the Schedule AL as well. Schedule AL is nothing but assets and liabilities. So one is a Schedule FA and another one is a Schedule AL. Schedule AL is applicable only if your total income is more than 50 lakhs. So then recently one amendment which has come in the budget is, if your value of the foreign asset is not exceeding 20 lakh rupees, then you need not be penalized. You will not be penalized with the penalty. That does not mean that you are absolved from the reporting. It is only thing that because of the ignorance or because of the negligence, if you have not reported up to 20 lakhs, if the value is less than 20 lakhs, then the penalty will not be levied. That does not mean that prosecution will not trigger. On the new amendment does not talk about prosecution. So it is advisable to report the stocks irrespective of the values. And another question which may come up is, in Schedule AL also if I report and Schedule FA also I report, so there is a duplication of information and I'm inflating the values. So I'm putting in both the places. See, it is not an inflating the value. Tax authorities have clarified that the purposes of Schedule AL and Schedule FA are totally different, and they are not going to reckon that as two different numbers and add it up to arrive at your total asset value. So they see these separate things and they will consider for the required purposes accordingly. So there is nothing wrong in reporting in schedule. Rather, I mean, it is mandate to report in both the places. So now comes the other issues, basically FEMA foreign perspective. What are the issues to be considered for these stock awards? So one recently which I come across which I came across is one of my clients who is a resident Indian wanted to gift these stocks to his son who is in the US, and he is a non-resident in India. He is a resident in the US, so he is an NRI. So it is a gift of the stock acquired through the stock option to relative who is a son who is an NRI. Whether FEMA permits this? FEMA does not permit this transaction. See here the example: parent Mr. Y is in India, and it is shares of Apple Inc. And Apple is a USA company, and the shares are listed in US. And he would like to gift it to the son who is in the US. So this transaction is not permitted at all. So stocks which have been acquired through stock awards cannot be gifted by a resident Indian to a non-resident, though he is a relative. The overseas investment directions of para 22.4 clearly bars this transaction. So the prohibition is applicable. Then another question which crops up is repatriation of sale proceeds. So once I sell the stocks which are listed abroad, whether do I need to immediately repat this money? Which do I need to get this money back to India, or can I invest further in the US itself? Earlier, before August 2022, there was a mandatory requirement to repatriate the funds as soon as possible at any cost. It cannot be more than 90 days. The delay cannot be more than 90 days. The wording used were mandatory to repatriate as soon as possible, but not more than 90 days. So in unavoidable situations, they had given a grace period of 90 days. But this has been changed dramatically. So now the rule is it can be reinvested abroad. And if the time period given for the reinvestment is 180 days. So if you are unable to reinvest within 180 days, then you have to immediately bring the money back to India. So that's all from my side. I think I have taken enough time. We were supposed to close it by 5:45 and 15 minutes for questions, but the time has exceeded. So if anybody has any questions, let us take up those questions. I'll stop sharing my screen.
Thank you, Amarnath. Thank you for the insightful webinar. So attendees, if you have any question, please put your questions in the Q&A section. There is one question. So is there a vesting date for SARS? So I think SARS is nothing but stock appreciation right.
Yeah, so there will be a vesting date to calculate the gain amount. As I mentioned, SARS is based on the fair market value as on a particular date. So vesting date would be there, and that date would be considered to arrive at the cash benefit to be paid to the employee.
Sure, thank you. I think that answered your question. And then what are the risks involved in double taxation on ESOPs? That is one more question which is asked by Nikita.
So as we discussed, there are several risks associated with the double taxation, cross-border taxation. One is reporting perspective, need to be reported in Schedule FA. Then the taxation of pro rata taxation, where both the countries it may get taxed, and the employee has to claim foreign tax credit in India by filing the tax return. So like this, there are several challenges. So there is one more question. Schedule FA is to be reported on unrealized gains or only at the time of sale or reporting purposes for resident individuals. Schedule FA need to be reported when you are holding the stock as a owner of the stock. Once the allotment has happened and the stocks are getting credited to your account, from that date onwards, you should start reporting in Schedule FA. And once the stocks are disposed, that year ends the reporting requirement for that particular stock. So as on December 31st, you may not hold the stock. You might have sold the stock in the mid of the year, but still you need to report and then report the sale as well in the Schedule FA.
And there is one more question. Under FEMA, shares can't be gifted to NRIs or even RIs?
RIs, yes, it can be gifted, but not for NRIs. We discussed this just now. Yeah.
Okay. And there's one more question. What are the fringe benefit tax on ESOPs?
Now, there is no fringe benefit tax at this point in time. Fringe benefit tax was abolished from 2009 onwards. Prior to 2009, fringe benefit tax was there. So, if the stocks were acquired prior to 2009 and if it is being sold now, then whatever the value considered for fringe benefit tax purposes is going to be the cost price or the purchase price for the stocks.
Sure, fine. Due to time constraints, we will be taking one last question. So,
Yeah.
do we get credit of tax withheld on dividend at the rate 25% or 30% in US for Indian ITR?
Yes, you do get the foreign tax credit for the taxes withheld in the US. Generally, US person will issue a form called 1042S. So, based on that form, you can claim the foreign tax credit in India tax return.
Sure. Thank you. It was a wonderful session. And a small request from the attendees. So, we'll be just posting the polls at this point in time. Kindly answer that. Thank you. Most of the results were out. And one final thing is, we wanted to also know that what are the topics you would like to for the next webinar from Dilzer. So you can just update that. So we have shared you this one. Sure. Thank you all. Thank you, Amanat, for the wonderful session. Hope to see you all again with another
Thank you,
session.
all participants, and thanks to Dilzer Consultant for giving me an opportunity to present my views on stock awards. Thank you.
Thank you. Thank you all. Have a nice day.